Good afternoon. Thank you for joining Corporate Connect. I'm Eileen and I'm your host for today. This afternoon, we welcome First REIT, our corporate sponsors, as well as audience from Facebook Live. This webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with a presentation by Mr. Jeff Howie, Market Strategist from SGX Group on recent market highlights, followed by a corporate presentation by Mr. Victor Tan, Chief Executive Officer from First REIT, and we will end off with a Q&A session. Listed on the Singapore Stock Exchange on 11 December 2006, First REIT is Singapore's first healthcare REIT that aims to invest in a diversified portfolio of income-producing real estate or real estate-related assets in Asia that are primarily used for healthcare or healthcare-related purposes. The trust has diversified asset portfolio of 32 properties, comprising 15 in Indonesia, 3 in Singapore, and 14 in Japan. The properties are collectively valued at over 1.15 million as at 31st December 2022. Without further ado, may I just invite Mr. Jeff Howie to give us a market update. So over to you, Jeff.
Yeah, so very quickly, I will provide a very quick 10-minute overview of our real estate investment trust sector before Victor provides the Corporate Connect event outlining First REIT. So what I want to do is just basically go through the sector very quickly. As usual, it represents around 10 to 11% thereabouts of the total market capitalization of all the stocks listed in the Singapore stock market. That's our REIT sector, comprising 40 REITs. But they do account for much more than that in trading turnover. So on an average trading day, around 20 cents in every dollar that goes to work in the Singapore stock market is actually going to work in the Singapore REIT sector. And that, I guess, that 12% contribution to total market cap, as well as the 20% contribution by the 40 trusts to our turnover, it is comparatively high. For some global perspective, there's around $2 trillion of market value of REITs across the world. So that's around 2% of total market cap. REITs have been in the US for some time, for more than 60 years, and they make up around They make up around a quarter of the 800 REITs across the world, but they do make up around 65% of the total market capitalization of the market value of all REITs. So US REITs are generally pretty big in terms of size, and thus their relevant drivers do have a significant impact on the overall tide of fundamentals devaluations in the global REIT market. The global REIT benchmark, the FTSE EPRA REIT Global REITs Index, it's generated a 1% decline in total return so far this year, and that follows a 24% decline in total return last year. That's coincided, obviously, with persistent inflation in the US and expectations that the federal funds reserve rate will stay at 5.5% thereabouts by the end of 2023. And going off what some incoming FOMC voters, Barkin and Bostic mentioned last week, you've got those rates pretty high all the way through to 2024 as well. So since the end of 2019, that FTSE EPRA REIT Global REITs Index, so we're taking out the developers and just looking at the REIT aspect of the EPRA REIT Index, through to now have pretty much declined around 10%. And the IHS REIT Index has declined similar, around 8% in total return. Now, those 3.5 years of returns, they pretty much were within 5 to 10% of each other. But the two indices, the Global REITs Index and the IHS REIT Index, they average around a 0.7% rolling 120-day correlation coefficient. And that does show that there's an element of differentiation, I guess, in the day-to-day moves still for those two indices for portfolio managers. In Singapore, as many as 17 of the trusts exclusively invest in properties outside of Singapore. 20 of the trusts invest in properties in both Singapore and outside Singapore, and you just have the 3 remaining REITs investing purely in Singapore. And that includes as many as 14 trusts with properties in Australia, 11 trusts with properties in China, 11 trusts with properties in Japan, and then, of course, 9 trusts with properties in the US as well. So across the REIT sector here in Singapore, 80% of these trusts own and manage assets overseas from across Asia Pacific, United States, Europe, and that makes S-REITs now one of the most international REIT markets in the world. The average yield for the majority of the 40 S-REITs was around 8% at the end of May, while the yield for the IHS REIT index was at 6.4%. As Singapore REITs and property trusts, as they have continued to diversify in terms of asset mix over the last 3 years, diversified S-REITs also now make up the largest subsegment of the sector. And more diversification, it can improve a REIT's resilience to external shocks, and it does allow it to capture growth trends, obviously across more, or in fact, a multitude of segments. Looking at the 40 REITs and the property trusts of the S-REIT sector, the average gearing ratio as of the end of May was at 38.1%. First REIT's pretty much on that at 39%. And they're below the regulatory limit of 50% if the minimum interest coverage ratio is at least 2.5 times. If the interest coverage ratio, if it is below 2.5 times, then maximal allowable leverage limit is 45%. And that interest coverage ratio, it's used to determine how easily a REIT can pay interest on its outstanding debt. That limit, it was increased in April of 2020. And that was in order to provide the sector with more flexibility to manage capital structures during the pandemic. But based on the available filings, if you look across the sector, your average interest coverage ratio was around 4.6 times, so well above that 2.5 times. The 5 trusts with the highest average interest coverage ratio, or adjusted when used, they were Parkway Life REIT, Daiwa House Logistics Trust, Fraser Logistics Commercial Trust, IREIT Global, and Keppel DC REIT. Among the 40 trusts as well, all of them have gearing ratios within the regulatory limits, and half of them, or 20 of the trusts, have ratios at or below the sector's average, obviously. The 3 REITs with the lowest gearing ratio of the 40 being SIAS REIT, Fraser Logistics Commercial Trust, and Paragon REIT, which were below 30%. On that gearing ratio, though, do note that according to the Code of Collective Investment Schemes, the aggregate leverage limit is not considered to be breached if it's due to the circumstances beyond the control of the manager. And that includes depreciation in the asset value of the property fund or any redemption of units or payments made from the property fund. And if the aggregate limit is exceeded as a result of those examples, the manager should not incur additional borrowings or enter into further deferred payment arrangements. I just wanted to cover this very quickly. Let me just move this off the screen there, sorry. Just on the acquisition front, there have been 6 acquisitions announced over the first 5 months of the year with a combined value of 2.5 billion Sing dollars. The most recent was Mapletree Industrial Trust announcing that acquisition of a data center in downtown Osaka, Japan, and that was valued at 508 million Sing, and that's as of the end of May. I'm quoting these numbers. That private placement, it was approximately 4.5 times covered at $2.21 thereabouts for a unit. And it made MIT's first foray into the Japanese data center market as well, which is helping it to further diversify its portfolio. So post-acquisition, Japan will account for 5.5% of Mapletree Industrial Trust portfolio by assets under management. You've got North America around 48%, and you've got Singapore around 47%. Across 2021 and 2022 as well, around half of the trusts of the S-REIT sector pursued acquisitions in efforts to further enhance unit holder value. In terms of yield spread, despite these increasing rate backdrop, S-REITs are still offering a higher yield spread of around 340 basis points above the Singapore government 10-year bond yields, and they're at 3%. So the last 4 years have seen that FTSE ST REIT index price to book ratio as well, which is in the looking at the price to book ratio on the far right here, in the green line, it alternated from a 20% premium to book value to a 20% discount and back to a 20%, it's back to a 10% discount, sorry, at present. The FTSE ST REIT index currently has a price to book ratio of 0.9 times. So that's around a 15% discount to its 5-year average PB, which is around 1.5 times, 1.05 times, sorry, 1.05 times. So it's at 0.9 versus the 5-year average of 1.05. And by comparison, global REITs have seen greater dispersion in their book values over recent years. Your FTSE EPRA NAREIT Global REIT Index has alternated from a 2.7 times book value in December at the end of 2021 to a 1.8 times value in October 2022, and it's back to 2.0 at present, which is around about a 10% discount to its 5-year average. So we're a little bit more of a discount to our 5-year average than the global peers, which, as we said, global peers are very much heavily weighted to the bigger REITs in the United States. Just one final point as we wrap up before Victor comes on, is that S-REITs do offer one of the highest dividend yields and lower volatilities when you look across these various index in Asia Pacific. And also, we've also seen as the S-REIT ecosystem matures, we're also seeing a shelf of REIT ETFs listed on SGX grow significantly from 3 REITs with a combined assets under management of just over 350 million Sing dollars 3 years ago, up to 5 ETFs now with a combined AUM of around 870 million Sing. So many of the themes, obviously the high interest rates, decelerating growth on a macro front have been really important as well for the S-REIT sector. But also what has been really important too is that more microeconomic strategic initiatives, growth strategies per se, has also been an element of great importance to the REIT sector. And I know Victor has his 2.0 growth strategy, which is a fourfold strategic initiative that I'm now going to finish off on and have Victor elaborate more on First REIT first, and I'm sure he'll touch on the execution of the Growth 2 strategy, which I'm really looking forward to hearing more of. Thank you so much, Eileen, and thank you, Victor. Look forward to hearing from you soon.
Thank you, Jeff. We now invite Victor Tan, Chief Executive Officer from First REIT. Over to you, Victor.
Thanks, Eileen, and thanks, Jeff. Yeah. Okay. Good afternoon, ladies and gentlemen. Thanks for joining us, in today's webinar. If you look at the slide for this afternoon, you'll see that there are actually some Japanese word, on the caption. Is because we just came back from Tokyo. Me and my investor relation manager, we just came back from a investor meeting, non-deal roadshow in Tokyo. We have quite a number of very good meeting, there with some institutional investor in Tokyo. Some of this fund, we have actually met them a couple of years ago. So it's actually very good, for us to kind of reconnect with them once again. Yeah. Okay, so maybe what I'll do is I'll just give a very quick update on First REIT, and then I will take Q&A from there. Okay, a quick overview of First REIT. We are actually the first healthcare REIT to be listed in Singapore. That was way back in December 2006. We started with 4 assets, from Indonesia, and market cap or asset size was around 300 million Sing dollar then. And over the year, we have grown to about 32 assets, across 3 countries in Asia now. And our asset under management is 1.15 billion Sing dollar as at 31st December 2022. Okay, so over in Indonesia, we have 15 assets. 14 of them are hospital, and then we have 1 hotel and country club. And then over in Japan, which we just entered the market last year, we now have 14 nursing homes in Japan, which contribute about 25% of our asset under management. And over in Singapore side, 3 nursing homes, which is about 3% of our asset under management. Okay, next slide. Okay, a quick overview of our structure. Maybe just one point to note is that since 2018, we have a new sponsor in OUE Limited as well as OUE Healthcare, and their combined stake in First REIT is 44.4% as of March this year. And of course, the sponsor owns 100% of the manager. Okay, so 60% is owned by OUE Limited, and then the other 40% is owned by OUE Healthcare. Okay, so this trust structure is actually, I think it's quite familiar with most of you, because this is actually this trust structure that's used by most of the S-REIT. So basically what usually the trust do is that the trust, as all the trusts in Singapore are externally managed. So we have a manager that manages the trust, and then of course we have the trustee that will report back and to unitholder that oversees the trust activity. And then for the asset that's held locally in Singapore, the trust can actually own the asset directly. And then for those offshore assets, like for instance, for our case, our asset in Indonesia and our assets in Japan, these are held through a series of local onshore special purpose company, and then the onshore special purpose company will actually owns the offshore company that owns the trust, or rather owns the asset in that foreign country. Okay. Next slide. Okay, a quick slide on our very long leases. Okay, our leases are all very long leases. It's largely due to the nature of asset, because these are healthcare assets. Okay, so it's either hospital or nursing home. Hence, all our leases are master leases, and we only have one operator or one tenant in our lease structure. Hence, all our leases are all very long dated. Indonesia is 15 years with option to renew for another 15 years, and then for the Japan side is either 20-year or 30-year lease, and then Singapore is actually 10 plus 10. Okay, hence our weighted average lease to expiry is very long, 12.2 years, and our committed occupancy is 100%. Because I said earlier on, there is every asset we have one operator. Okay, more on our lease structure. Okay, over at the Indonesia side, maybe what I'll do is that I will just share the leases that is post the restructuring. That means the leases that is since 2021. Okay, so post the restructuring, our leases is Indonesia. They will be receiving our rental income in Indonesia rupiah, but there will be a base rent, and our base rent every year it will be subject to a annual 4.5% annual escalation, which means that our rental income in Indonesia will go up by at least 4.5%, and this 4.5% is basically to to cater to the CPI, and also the any potential forex exposure as well, But on top of this base rent, which is escalating at 4.5% annually, we also have another performance-based rent. Okay, this performance-based rent is basically to capture any potential upside, any potential, if the asset or the hospital in Indonesia perform well, we will get to enjoy a bit of the upside. Okay, and this performance-based rent is actually based on the 8% of the preceding financial year gross operating revenue. Okay, and the formula is such that if you look at the base rent, which is going up by 4.5% annually, and versus the 8% gross operating revenue of the hospital, whichever is the higher number, we'll take the higher number as our rent for the particular asset, and we are comparing asset by asset. So that means each asset, we will look at the 8% of the gross operating revenue and compare it against the base rent, which is going up by 4.5% annually. Whichever is the higher number, we'll take the higher number as our rental income for the year. Okay, and I'm also happy to report that out of the 14 hospitals that we have gone through the restructuring, 3 of them already enjoy the performance-based rent, which means that these three hospitals, the annual increment is actually more than the 4.5% that we are receiving from the other hospital. Okay, and over at the Japan side, our rental are basically fixed. Okay, but we do have a clause in our agreement that every 2 to 3 years we can actually negotiate for a higher rental. Of course, this will be based on any increase in the Japan consumer price index and also the interest rate. And of course, in Japan, we will receive our rental income in Japanese yen. And Singapore, the 3 nursing homes in Singapore, fixed base rent with annual escalation of 2%. The rental will be increasing by 2% annually. And of course, Singapore, we receive our rental income in Sing dollar. And just one more point to note on the lease structure. For the Indonesia portfolio, all our leases are on triple net basis. Okay, what I mean by triple net is that the tenant or the operator will be taking care of the daily upkeep of the hospital, and also they will be paying for the insurance cost as well as paying for the property tax. Okay, whereas in Japan, there's only one asset that we will be receiving on the triple net, whereas the other 13 assets we will have to pay for the insurance as well as the property tax. And then in Singapore, out of the 3 nursing homes, 2 of them are on triple net basis. Only one of them is on double net, which means for the particular nursing home, we will have to bear the property tax. Next slide. Okay, a quick overview of our financial performance since 2020. Okay, and 2021, sorry. 2021 is because this is the first year that we have this is the year that after we have announced our restructuring. Okay, so if you look at the result post the restructuring, we are able to deliver very stable rental and other income, as well as net property and other income. I mentioned earlier in my previous slide that all our leases, or most of our leases, especially those that is Indonesia, are on triple net basis, and there's very little property expenses that we need to bear. Hence, the rental and other income and the net property and other income, the two numbers are quite identical because there is very, very little leakage, in between these two lines. And of course, if you look at the slide on the left side, you will see that there's some fluctuation. Basically the bar shaded code is basically, this is actually the accounting adjustment that we actually need to put through for our rental income. Okay, so if you were to strip off this one-off or this accounting adjustment, which doesn't affect our actual rental income, you will see that our rental income has been very stable throughout the last 9-10 quarter, post our restructuring. Okay, our total debt post our restructuring has gone up from 350 million to about 464 million. The increase in our borrowing is actually due to the loan that we draw down to for our Japan acquisition in FY 2020. Okay, and our gearing has also gone up from 34% to about 39%. One of the major factors is also due to our acquisition in Japan. Our weighted average debt to maturity has actually improved from 1 time to about 3 times now. I will elaborate a little bit more on this, in the following slide. And our all-in cost of debt has also gone up from 4.2% to 4.7%, and the increase is also because we have actually taken the initiative to fix quite a lot of our debt, due to the rising interest rate environment. Our interest cover ratio 5.2 times, although it dipped to 4.2 times, but it's still very healthy. It's still above the 2.5 times. Interest cover ratio that is stated that for us to increase our gearing from 45% to 50%, the 2.5 times interest cover ratio will be very important. Okay, and then in terms of the percentage of debt, with fixed rate or hedge, we also have increased from 56 times to about 63 times now. Next slide. Okay, a quick summary of our execution of our 2.0 growth strategy that Jeff mentioned earlier on. Since 2021, post the restructuring, we have actually come out with this First REIT 2.0 growth strategy. And there are 4 pillars to this 2.0 growth strategy. Of course, the main pillar is that we want to diversify into developed market. And we want to increase our portfolio in the developed market to over 25% of our asset under management by FY 2027. Okay, and since last year, we already started to enter into a Japan market. As of now, 25% of our asset under management is already in Japan, plus another 3% of our asset in Singapore. So close to 28% of our asset under management is already in the developed market as of last year. And our target is that within the next few years, more than 50% of our asset under management will be in developed market. So we are right on track, as far as this divestment strategy is concerned. Okay, and the second pillar in our growth strategy is that we also want to reshape our portfolio so that we can actually recycle some of this capital from non-core, non-healthcare, and also mature asset for better capital efficient growth. Okay, and to this front, we also have completed divestment of our one of the mature hospitals, Siloam Hospital, Surabaya, in December 2022. This was one of the assets that we have acquired at IPO, about 17 years ago, and we feel that it's right for us to actually cash in on this particular asset and recycle this particular proceed, to other better efficient growth. And we also have identified another of our non-core asset, which is the hotel and country club. Again, this asset was also acquired during IPO, and we already have marketed this particular asset for divestment, and we are hopeful that this particular asset will be we will be able to divest it in the near future, so that we can recycle more of this capital into the developed market. Yeah, and as we continue to grow, as we continue to look for asset in the developed market, also we want to strengthen our capital structure so that we can remain resilient. And one of these regards is that we want to be able to diversify our funding sources so that we can optimize our financial position. And 2022, last year, we are also able to successfully price Singapore First Healthcare Social Bond. This is actually a tie-up with a trust bank of Asia Development Bank, ADB, CGIF, and CGIF is actually helping us to launch this particular social bond. And also early this year, we are also able to, in fact, it was actually last year, towards the end of December last year, we are also able to do a early refinancing of one of our debt that's actually due for first quarter of this year. Hence, there's no refinancing need for us until May 2025. Okay, and last but not least, we also want to continue to pivot to ride the latest mega trend, which means that we want to improve our ESG. We want to ride on opportunity in the aging demography in the developed market, as well as the under-penetrated healthcare sector, in particular Indonesia. Okay, so this in a nutshell is actually our 2.0 growth strategy, and we are actively executing and pursuing this 2.0 growth strategy going forward. Okay, maybe a quick slide on our entry into Japan in 2022. Okay, so last year, we are able to complete the acquisition of 12 well-established freehold nursing home, and this particular portfolio actually came from our sponsor, OUE Healthcare, and we are able to acquire them for 24.2 billion Japanese yen. And then shortly after that, in September 2022, we're also able to complete another acquisition of 2 high-quality freehold nursing homes. And these 2 nursing homes actually come from a third party. And so as of now, we have 14 nursing homes, and these 14 nursing homes are operated by 5 independent, well-established, as well as experienced operators. Yeah, so not only are we able to diversify into a new geographical country, Japan, we're also able to diversify our tenant base. I think in the past, we only have about 2 or 3 tenants in Japan. Now we are also able to add another 5 quality tenant in Japan as well. And this tenant, as you can see, they have many years of operating track record, especially the one in Hokkaido, where most of our property are based. These are operated by Hickory Heights, where they have 35 years of operating experience, and they are listed in Sapporo Stock Exchange as well. Next slide. Okay, I mentioned earlier on about diversifying our tenant base. Okay, now we are also able to increase our third-party tenant. At the same time, we also are able to have higher direct contribution from Siloam, which is the operator of all our hospitals in Indonesia, and they are the largest private hospital network in Indonesia. Okay, so as you can see, as of now, currently we have about 11 tenants, as compared to in the past, we only have about 3 of them, or 3-4 of them. And if you look at the rental contribution from Indonesia side, in the past, most of our rental will come from Lippo Karachi. So as of now, 56% will come from Lippo Karachi, and then the remaining 44% will come from the operator Siloam itself. Okay, and going forward, we expect this number to increase to more than 80% in time to come. Next slide. Okay, this slide shows we have been able to strengthen our capital structure. As of now, I shared earlier on that we are able to do an early refinancing of one of the debt that's actually due first quarter of this year. And hence, there's no refinancing need for us until May 2025. And this May 2025 is actually the TNK bond. Okay, this is the bond that we used to finance our Japan acquisition, when we acquired them last year. And as I was saying this, we are actually looking at trying to fix this particular bond, and also perhaps do an early refinancing as well. Okay, if you look at our debt maturity profile, if you are able to refinance this 21% debt, there won't be any refinancing until 2026. And if you look at the total debt as of March of 465 million, 63% of our debt is actually on fixed rate, or they are actually hedged using the interest rate derivative. Okay, and we also, and you'll see that most of the loan that we have hedged here are the Sing dollar loan. Well, for the Japanese loan, we also have some fixed loan, but the bulk of it are actually on floating. Since Japan is still enjoying the low interest rate environment, and there's also some talk about with the new Bank of Japan governor coming on board, he might be looking at some of the financial or even interest rate strategy. Hence, we feel that it may be a good time, for us to also try to fix some of this Japanese loan as well. Okay, next slide. Okay, this is my final slide. Basically, post the restructuring, we are on track to be able to deliver very sustainable distribution or DPU to our unit holder. As of now, our dividend yield is about 9.5%, and our price to book ratio is actually 0.87 times. As you can see from the slide, that post the restructuring, in 2021, 2022, and even first quarter of this year, we are able to deliver very stable and very sustainable DPU to our unit holder. And we certainly confident that this particular trend will be able to continue into the near future. Okay, thank you very much. I think this is all I have to share on our presentation. Maybe I will just take some questions from here. Yeah.
Thank you, Victor, for the informative presentation. We'll now move to the Q&A session. Please feel free to submit the questions in the chat box for audience who have logged in. For Facebook audience, you can also click on the link to join us in the Zoom and post your questions. We'll try to answer the question as many as possible. Right now, may I just invite Mr. Benjamin Goh, Head of Research and Investor Education from SIAS, to moderate the session. Over to you, Ben.
Thank you very much, Eileen. Victor, thank you very much for joining us. Always a pleasure to have you here every quarter.
It's always nice to join you. Yeah.
Okay, I was going through the presentation slides, very informative. We do have a couple of pre-submitted questions. We're going to kick off with the questions regarding growth strategy, execution, as well as outlook for First REIT. All right. So you had a slide showing the active execution of 2.0 growth strategy. There were a couple of questions regarding, I guess specifically, what does this mean? I mean, would you be add more color to, let's say, the assets that you might be contemplating buying, purchasing, any kind of asset recycling initiatives that you're thinking of? And again, there was a objective of increasing up to 50% of AUM in developed countries. So what does that mean for Singapore as well as Japan?
Yeah, sure. Thanks for this question. Yeah. So post the restructuring in 2020, we feel that in fact my board and I feel that we should diversify into developed market, so that we can release or rather reduce our risk, in the developing market, and that is probably one of the problems that we have, for us to actually do the restructuring, because that time we are just over concentrated in one country and just rely on a couple of handful of tenants, hence we've developed this 2.0 growth strategy. And our 2.0 growth strategy, one of the key pillars is that we want to be able to diversify into developed market. Yeah. And we have identified a couple of developed markets. And during those times, it so happened that our new sponsor since 2018, OUE Healthcare, is able to support us in this particular strategy, in the sense that they have a portfolio of nursing home in Japan. So that actually allow us to be able to make a very incisive maiden acquisition into Japanese market, because the particular portfolio is very sizable for us, so it's a very good portfolio for us to establish a foothold in Japan, And since then, we begins to feel that Japan continue to be able to provide a very good target for us to acquire, and since then we also are able to acquire another 2 more nursing homes in Japan. And when we acquire this particular portfolio in Japan, not only we are able to acquire the asset in Japan, we are also able to acquire a company in Japan, which this company actually has 3 staff in there. Hence we are also able to acquire this company that come with 3 employees, and one of them is a very experienced senior person in Japan, which again will allow us to be able to look more into the Japanese market, because now we actually have a foot on the ground, and due to his experience, due to his connection in Japan, we will be able to have the benefit to look at more potential target in Japan. So definitely Japan is one of the key market that we will be looking at, and of course, with the low interest rate environment in Japan, allow us to be able to make creative acquisition in there. This is the reason why you see that there are also some other REIT, S-REIT, and also some other investors, start looking at the Japan market. But other than Japan, we are also looking at other developed market, and of course, Singapore is also another market that we are keen to expand our reach or expand our size. But unfortunately, in Singapore, there's not many healthcare assets that potentially we can look at and acquire. And of course, a couple of weeks ago, I just came back from Australia. So Australia is also another developed market that is well liked by many S-REIT. So potentially this could also be another market that we look at in the near future. So we feel that by diversifying into developed market, we will be able to manage and be able to cut down or reduce our risk going forward. If you look at our current yield, we are trading at 9.5% or even close to 10% at certain time. Last year also and this is higher than the S-REIT yield, dividend yield, average dividend yield that Jess shared early on. Although I thought the number was a bit lower, but just now when Jess shared of 8%, it seems to be on a much higher side. I thought the average S-REIT yield is close to 6 to 7%. But we are trading at much higher than this average yield. It's last year also because of the risk exposure that we had. So by diversifying into developed market, hopefully market will start to re-rate us, because of our risk profile. Hence, it will hopefully be reflected in our dividend yield going forward as well.
Well, just to jump in, Victor, your 12 months dividend yield stands at 10.2% actually.
That's right. I'm saying, yeah, precisely. So it's still higher than the average S-REIT yield. So we're just hoping that by entering into a developed market, by having more and more assets in the developed market, hopefully, when we hit more than 50% of our asset under management in developed market, market will start to look at re-rating us, and hence our dividend yield may come off to a more palatable level.
There was a specific question about Singapore assets. So this is regarding the Orange Valley nursing homes. So I guess the question here is that the number of Singapore assets in your portfolio stands at very small percentage, and Orange Valley nursing home from this participant wondering whether there are plans to acquire that kind of homes or similar for your Singapore portfolio.
No, definitely. I mean, we are still very keen in looking at some of the nursing home market in Singapore, and we actually have owned 3 nursing homes. So definitely we are looking at we wanted to look at more. If you ask me personally, I want to buy more nursing homes in Singapore. Orange Valley nursing home, of course, now is owned by another party, which you probably know who owned them, and they recently just gone through some restructuring as well. In fact, we are in touch with them. Okay, we have actually been talking to them for a while, but they haven't really decided whether they want to keep them or they want to divest them. But even if they choose to divest them, it doesn't come cheap, so it may not make sense for us if it's at that kind of pricing, and I'm also we're also talking to other nursing home operator in Singapore as well. So we're also talking to another listed entity and some smaller group as well, But as you probably know, I think the nursing home market is really doing well, and because Singapore is also experiencing aging population, and there's also some talk that we might be following Japan going into this super aged country soon. So I guess there's also a lot of demand, for nursing home asset in Singapore. So I think the operator definitely holding on to their asset, and also in nursing home, Singapore nursing home market, there's also quite a number of nursing homes that's owned by VWO or those non-profit organizations. Hence these are assets that probably they will not keen to sell, But I mean, if there are assets that are available, we definitely will be keen to look at acquiring them. And at the same time, because now that we are under OUE, so OUE Limited is actually a developer, and OUE Healthcare, our immediate parents, is actually an operator. So we are also keen to collaborate with them. But for instance, recently government also announced that there are 2 sites that is up for some tender, to build nursing home or build some form of retirement home, that kind of nature. So we are discussing with our sponsor, parent to potentially look at, working with them to see whether we can be involved in some of these project, whereby OUE can develop the site, and then one completed OUE healthcare can operate, and we can actually owns the land and building of that nursing home.
Okay. Okay. Yeah, I still need to have that coffee if you to joke my spot. In about 20 years, I need a room.
Yeah.
Okay, so jokes aside, so your stated strategy is to have 50% of your AUM in developed countries. And again, very big presence in Indonesia and Japan. So there are a couple of questions here regarding FX as well as interest rate volatility. Because the large portion of your AUM is outside of Singapore. So how does First REIT or what kind of outlook does First REIT have in terms of FX volatility, and what are the steps that First REIT have taken to kind of mitigate those risks?
Yeah, that's right. I mean, if you look at the rental income that we have, from overseas, for instance, Indonesia, 72% of rental income come from them. Although I have to say that there are a small portion that's in Sing dollar, but the bulk of it are actually in Indonesia rupiah. If you look at the Indonesia rupiah per se, post the restructuring in 2020, 2021, Indonesia rupiah hasn't performed badly. Okay, in fact, Indonesia rupiah has been very consistent post the restructuring until maybe about 6-7 months ago, when they start to depreciate against Sing dollar. But having said that, right, Indonesia rupiah didn't perform that badly against major currency. Unfortunately, Sing dollar is a bit too strong. Okay. Okay. And in fact, if you look at the outlook for Indonesia rupiah for this year, right, one of the research house was just saying that they expecting Indonesia rupiah to strengthen against major currency. I'm not sure whether that is it includes Singapore as well, but Indonesia rupiah actually has been one of the best performing currency, in the world. And we talked to a lot of banks, and their house view is that Indonesia rupiah should outperform against major currency, most currency, in that sense. So, but in this regards, right, because most of our rental income come from Indonesia, and we also wanted to deliver a very stable and sustainable dividend to our unit holder. Hence, what we do is that we actually will hedge 50% or even slightly more than 50% of our rental income in rupiah, at least for a 12-month rolling period. Okay, so that's our strategy. And the reason why we didn't hedge 100% is also because of the how our view is that Indonesia rupiah should be able to perform well, against major currency. Yeah. And then of course the next group of rental income that we have overseas is actually the Japan yen. We just entered into last year. Again, Japanese yen has been depreciating against Sing dollar, quite gradually. But again, there are also talk that with this new Bank of Japan governor coming on board, and also the whole world has raised interest rate, but not Japan. So how are they going to? And the reason why they haven't been raising interest rates is because they have never experienced inflation for the past 2-3 decades. But they have been starting to see a bit of inflation, for the past year or so, and the inflation has gone up to 2-4%, which is their desirable level. So the new person in charge, may decide, to adjust some of their monetary policy going forward, and that is what a lot of experts is saying. So potentially Japan may be starting to hike their interest rate, although not likely to hike aggressively like the rest of the world. Maybe 25 to 50 basis points the max. So if they start to hike interest rate, potentially Japanese yen may strengthen against most currency. Yeah. And because on the Japan side, only maybe 20+% of our rental income come from there. So at this moment, we will continue to monitor the Japanese yen market. We are not really entering into any hedging strategy there, but we are monitoring that very closely. And also on the interest rate side, as I shared in one of the slides, although Japan hasn't hiked the interest rate, but there is a risk that they may be doing so. And since it's still cheap for us to fix the Japanese yen, so we are exploring to fix some of this Japan yen borrowing, so that in time to come, hopefully close to 85% or even 90% of our debt will be on a fixed rate basis. So that will help us to manage our interest rate exposure, going forward.
It's a bit like catching a falling knife. You don't know when the yen will be cheapest, right? So that might be a bit challenging.
It's true. And this probably one of the reasons why we are not hedging the Japanese yen, because there are a lot of talk that now could be the most expensive part, in the sense, and there's a high chance that Japanese yen may strengthen against the other major currencies. So you have separate comments?
Oh, hi everyone. I'm the IR manager at First REIT. So also just to add that it helps that we have built in escalation in our leases for Indonesia to manage the FX risk as well. Yeah.
Yeah, thanks for. I think that's a very good point. Yeah, I also shared earlier on that Indonesia side at least 4.5%. That actually helped to mitigate some of the forex exposure for the rupiah currency. Yeah.
Okay, so given the economic environment, given the structures and mechanisms you put in, step up rent and your FX mitigation, as well as your interest rate hedging policy, right? So I'm just going to go for the jugular here. How does that impact your DPUs going forward? First, that's basically what we want to know, full stop.
Yeah, I think I shared early on also in my final slide that we have been able to dish out very stable DPU post the restructuring. Although I know this quarter, first quarter of this year, we reported a slight decline of our DPU, and this was actually largely due to the rupiah currency, because of the very strong Sing dollar. But we are very confident that we will be able to deliver very stable and sustainable DPU.
I'm sorry. Oh, okay. I mean, fair enough. So I guess this is one of the reasons why investors, local investors especially, invest in REIT, is basically for DPU.
Yeah. Because our interest rate is already more than less cover. I think in time to come, 85% of the loan will be on fixed rate. So that will help us to manage our interest rate cost. And then of course the rupiah currency, as I shared early on, Indonesia rupiah has been very stable. And also per share early on also that we have this annual escalation that it will be able to mitigate some of these rupiah currency risk. And I also want to add that our tenant, our operator, Siloam Hospital Group, also has been reporting very, very strong financial quarter on quarter. And I also shared earlier on that 3 of our hospitals has already started receiving the performance-based rent, which means that they come in at higher than the 4.5% annual escalation. And if the hospital continue to do well, and we certainly hope that there will be more asset or hospital that will be able to receive this performance-based rent going forward.
Okay. So diving a little bit deeper into something you brought up just now about the loans, right? So we got 2 questions here. What is the current average interest rate for your debt? I guess the kind of the weighted average for your entire debt. And the second question here is for the perpetuals. How much of the perpetuals is outstanding? And I suppose your perpetuals has got a redemption option, right, for First REIT.
Yeah, that's right. Okay, the average cost of debt that we have now is about 4.7%. Okay. And I think this is 4.755% is probably around there. I think going forward we should be able to manage around this level. Okay, the PERP, we actually have a PERP program, a very small PERP position, about 16 million. And last year we actually did a PERP buyback exercise. 40% of the PERP holder has actually tender, for this exercise. So there is about balance of around 30 over million. So it's a very small position for us, and of course this PERP will be due for a callback in 2026. Okay, another 3+ years from now, and at the time, of course, we can decide to call back, or we can actually decide to roll over like what we did previously. And the reason why we actually did we didn't call back and then we actually roll over is also because when we issued this PERP in 2016, we're actually paying all-in costs of about 5.68%. Okay, and then 2 years ago when we supposed to call back, which we didn't, the rate was actually revised downward. So it's actually good for the trust, and now this PERP is actually paying a coupon of less than 5%. It's only about 4.98%. So there is some saving, because we didn't actually call back this PERP. So this is actually good for the unit holder per se. Yeah.
Okay. Okay, back to your portfolio of assets. There was a specific question about the PT Metropolis Propertino Utama, which is in rental arrears. So the question is, I guess there's some concern from investors about what's happening there. And are they going to be paying up? Should we send them a pig sale or something? No, sorry, this is Muslim country. So, saying the approval. So, maybe you could add some color to that.
Yeah. Okay, maybe just a little bit of background on this particular tenant that we have. Okay, PT MPU in short. Okay, it's actually one of the joint venture partner with our former sponsor, Lippo Karawaci. Okay, and they are just like our former sponsor LK, whereby they are the developer and they develop a lot of these healthcare assets in Indonesia. Hence, you are able to actually divest them to us. So as of FY 2022, they only contribute about 6% of the rental income. So it's not a very big portion, and they are mainly a property developer, and they do not have a operating entity unlike LK, because LK actually have a subsidiary in Siloam, whereby they can leverage on this subsidiary to operate the hospital. Whereas for MPU, they do not have their own healthcare company. Hence, they will have to rely on Siloam to also operate the hospital for them. So they have to pay a rental, or rather they have to have a special deal with Siloam in the past, for them to operate the hospital. Okay, I know that they have been behind, in terms of their rental commitment to us, and largely also because the Indonesia property market has been not doing that well, over the past couple of years, especially during COVID. Although there is some pickup, in the property market, but it's still quite slack, hence they have experienced some financial difficulty. But we have actually constantly in touch with them, and they actually have come up with a proposed installment plan. Okay, so far they are able to keep pace with the installment plan. They come up with a few installment plan, and so far they are able to pay us some money based on the installment plan, and we will continue to monitor this very closely with them. And we have been discussing with them. They were actually telling us that they are looking at potentially divesting a couple of their assets. So that if they are able to divest some of these assets, potentially they will be able to repay all this rental bill to us. Okay. So as of now, I don't think there is any major risk that they will be defaulting us. I think they are really looking at divesting some of this asset, and some of these assets, they are in kind of like advanced stock, with some of the potential buyer as well.
Okay. All right, next. Since we're talking about the Indonesian asset, there was a question about the recently renegotiated lower rental fees from the principal tenant in Indonesia. So how is that?
I think they are referring to this asset that is during the restructuring, right? Okay. Yeah. Yeah, because this question wasn't quite specific. So I take it that it was actually due to the restructure asset that we have gone through, and that was actually done in 2020. And we actually have done a major exercise on that particular transaction, and we also have an EGM, and we have gone through a very lengthy process, and there is also a lot of material on that. I think if you're interested, you can go to our website to check more. But I think what I just want to share, in summary, is that during 2020, when our major tenant, LK Typography, is not able to pay us the rental, we have to go through a very difficult, challenging restructuring exercise. For us, we even have to consult, with a financial advisor, to help us, with all this restructuring. And we are also able to restructuring such that, this is very sustainable going forward, because the rental at that time, or in 2021, is actually based on 45% of the rent over EBITDA ratio. That means this rental is actually 45% of the operator EBITDA number, and this is actually very consistent with what some of the US healthcare REIT, as well as some of the Asian, healthcare REIT market. These are the rental that they're able to receive, from their tenant, this percentage. Yeah, and also we're also able to negotiate a higher escalation going forward, 4.5% annual escalation. At the same time, if the hospital do well, we're also able to capture some of the upside, in the sense that we are also able to introduce this performance-based rent component, and also share early on that 3 of the hospital is already enjoying the performance-based component, and that as the hospital continue to do well, we are hopeful that more hospital will be able to enjoy this performance-based rent in the coming year as well. Yeah.
Okay. Okay. So we have run out of time, but then just one more generic question, since quite a lot of the pre-submitted questions we're talking about it. The share price of First REIT, it's quite different compared to a couple of years ago, before COVID. So I guess the question here is, would investors be able to see some kind of catalyst to move the share price back to pre-COVID levels? So you talked a lot about the growth plans, and we understand the funding model, as well as interest rates, and so on and so forth. So what's your take on that, on the share price?
So I would say that, of course, share price is not something that we can control. Post the restructuring, we come out with this 2.0 growth strategy. That's to diversify into different market, and also share early on that, hopefully, as we have more and more assets in the different market, market will start to relook at us, to re-rate us, so in time to come, hopefully, as they re-rate us, our dividend yield will come down. Of course, when our dividend yield were to come down, that will translate to a higher share price for us. And this is something that we hope that we can achieve now. Hence, we're actively executing our 2.0 growth strategy going forward. Hopefully, this will be the so-called catalyst for our share price.
Yeah, and maybe I could add. So as a market specialist, REITs have had a bad run of luck, simply because of the inflation interest rate policies, globally speaking.
Yes.
So it's not just First REIT, but REITs in general, because now they are, if the Singapore savings bond rate is giving you a coupon of 4.5%, then, but that's 包家, Singapore government's 4.5% is 包家. Then of course, for a structure like REITs, that's a bit challenging, because it's equity, so on and so forth. So for our friends out there, yes, we want to question First REIT on the financials, but as an asset class, REITs have been having a hard time for the last year or so, simply because of global macro headwinds. That's a fact. All right. Okay. So thank you, Victor, as well as Pearl, for answering our questions. There were some tough questions, but thanks for answering all of them. Yeah, do save a room for me, preferably the one with the closest to the PlayStation. You have a recreation room. Right?
Sure. Thanks so much, Ben.
Okay.
Yeah. Thanks, everyone. Yeah, if you have
thanks,
further
Ben.
questions, you can reach out to me. My contact details are on the First REIT website.
Thank you.
Right.
Thank you, Victor, Pearl, and of course, Benjamin, for the colorful Q&A session. I think without further ado, I just want to just highlight that Corporate Connect is a bi-monthly webinar. Do visit our website to get updates on the upcoming investor education programs initiative. And of course, for the Investors Right campaign that we are going to launch it on the 22nd of July. Do join us at the SGX auditorium. You can also register on the link that we have just posted in the box. If you're interested to know more about the Investors Right, do join us. Once again, thank you, Victor, again, and Pearl, for joining this session. And of course, our audience, have a good lunch.
Thank you.
Bye.
See you next
Thank you
time.
very
Thank
much.
you. Bye-bye.